Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Chinese shares slide. Investors stay cautious ahead of a government announcement tomorrow that could unlock up to 2 trillion yuan of new stimulus for China's economy. Tesla's long-awaited Robotaxi is here. Elon Musk unveils the prototype at a glitzy event in California, saying production may start in 2026. Plus, spending cuts and tax hikes on business and the wealthy. The French budget's €60 billion effort to tackle the government's colossal debt pile. We'll bring you all the details. A very good morning. Happy Friday. We've got European futures pointing higher towards the end of the week after we got that CPI print out of the US yesterday. Hotter than expected, but also a slowdown in the labour market. So it presents a headache for the Federal Reserve as it plots its rate path ahead. Are we going to go from a jumbo cut to a smaller cut or even no cut at all? Pairing those bets on Fed cuts kind of took the wind out of the sails of the S&P yesterday after this record-breaking rally. But futures on Wall Street pretty flat as things stand at the moment. Let's flip the board over to the cross-asset picture because you've had Treasury yields really digesting this paring back of rate bets. But also the Fed speak. Atlanta Fed President Raphael Bostic saying that he's totally comfortable with skipping a rate cut. So currently the 2-year yield under that 4% level, 3.96% currently where we trade, 109 on euro dollar as we await the ECB meeting next week. It's in Slovenia this time, not Frankfurt. Brent, $79 a barrel, and gold, $2,645 an ounce as we close out this week. But let's head over to Asia now. We are looking towards this announcement from the China Finance Ministry of potentially more fiscal stimulus. Avril Hong is in Singapore. And Avril, what are the markets looking like as we head towards that announcement?
Well, it is bracing for disappointment. Take a look at how the CSI 300 is faring going into the weekend, potentially with those declines. And I think calibrating their expectations of what realistically we can see from China's finance ministry tomorrow at 10 a.m. local time. We have investors expecting as much as $283 billion in terms of fiscal stimulus potentially being announced. But it's not just about the amount. It is also really going to be very important to watch the target of that support because that will give us a sense of where the government's priorities lie. Now, what we're seeing on Chinese stocks today is going against the grain of the rest of the Asia Pacific where they are managing to clock gains and shrugging off more or less what we got out of the hotter than expected US CPI print. Now flip the board because if you are wondering the extent in which the cooling in Chinese equities has left us, take a look at the September bottom all the way to the October peak, gains of about 35%, and the recent petering out, those declines have taken those gains to about 24%. So keep that in mind as we look ahead to tomorrow. Flip the board again. I just wanted to highlight what we're seeing in the FX space because even though equities are down today, the yuan is managing gains, both offshore and onshore. But that is on a day where Asia Pacific currencies are all gaining ground except for the Japanese yen. The Korean won is getting an added boost after a hawkish cut from the central bank there, which joined this global wave of easing, a cut which was as expected, but to some came in hawkish, especially if you consider how 5 out of the 6 members on the board think that the rate's going to be kept at 3.25% for the next 3 months. So this is what we're seeing in this part of the world. Lizzie.
All right, Avril Hong in Singapore, we thank you. And it's going to be a busy weekend for you. We'll look ahead to that market reaction on the China announcement on Monday. But let's get back to the US. We've had 3 Fed officials shrugging off the higher than forecast US inflation print for September. So kind of suggesting that the US central bank can continue to lower interest rates. Let's get analysis now with Bloomberg's Valerie Teitel. Val, what do you make of it?
Look, that print yesterday on CPI came in hotter than expected, not just on one component, Lizzie, but all 4. Headline CPI year-on-year, month-on-month, and the core print year-on-year, month-on-month, all a tenth higher than expected. But the CPI print was released at the same time as jobless claims. And if you flip the board and just take a look at that jump in jobless claims really grabbed the market attention more than this hot CPI print. It was the biggest jump in 3 years. Now, a lot of the states reporting the higher jobless claims came from those states that were affected by the hurricane. So, there is an emphasis for policymakers maybe to look past this jump in jobless claims, but the market sure didn't. Two-year yields really reacted to this data. They dropped 6 basis points on yesterday's session. If we flip the board, we can just take a look at how two-year yields traded into yesterday's close. They fell 6 basis points yesterday, fell below this the level of 4%, and are trading now down 6 basis points in the last 2 sessions, Lizzie.
Okay, really interesting. 2 quarter-point cuts appearing to be the new status quo. Bloomberg's Valerie Teitel, we thank you for the update there. And next to Hollywood-style productions, Tesla's CEO Elon Musk unveiling a Robotaxi without a steering wheel or pedals at an event in California. Really a difficult moment, make or break for Tesla, the moment of truth. Let's see how he did.
We expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with timeframes, but in 2026.
Let's bring in Katrina Nicholas now for some analysis. Katrina, there was a lot of hype leading up to this event. Take us through what we know about the Cybercab. Is it going to be enough to satisfy investors?
Well, look, there is certainly a lot of hype around this. This event was held at a movie lot at Warner Brothers in Los Angeles. It was delayed by about an hour because there was a medical emergency in the crowd. But by the time it did get underway, there were over 1 million people watching just online. And a very futuristic car drove out. The doors opened like butterfly wings, and Musk stepped in and off he went for a ride. And it's really interesting to note that this car has no steering wheels or pedals. And that's something that is really hard to engineer when it has to brake, and also everything has to be totally camera based. And there were some 50 fully autonomous so-called cybercabs and Model Ys driving around this movie lot that people could, interact with and take rides themselves. Musk also said that this cybercab should be available in 2026 or at least before 2027 and cost below $30,000 US. Also on display, there was a prototype of a Robovan that Musk said could transport up to 20 people at a time. And also present was Tesla's Optimus humanoid robot, which Musk said, would be able to do anything you want, really, from babysit your kids to walk your dogs or mow your lawn. And indeed, we saw it there at the event. It was behind a bar, serving some drinks to people. At the end of the event, there were north of 3 million people watching this online. The event itself, though, was pretty brief. It was actually over and done with in about 40 minutes.
I feel like you've just taken me to the future, Katrina. So even though Musk would have everyone believe there's a lot to be excited about, I guess to some degree the jury's still out.
That's right. I mean, the event itself was pretty light on details. There was this $30,000 number, but outside of that, there weren't a lot of other facts and figures. There's been a lot of talk about this idea of a robotaxi fleet. If you've got a Tesla, you'd be able to sort of rent it out and have it autonomously drive around the street when you're not using it. And Musk sort of did say a little bit about how people could have their little fleet of cars, like they could tend to them like a flock of sheep. But, there really wasn't much detail other than that. And I think analysts are also going to be quite skeptical about this $30,000 price point and also the timeline, because, we all know Musk has just blown past timelines in the past. The Cybertruck, for example, was unveiled in 2019 and didn't actually go into production until late last year. And there also wasn't much detail of a cheaper car. People have been expecting something, a Tesla that would price closer to the $25,000 mark, and that would help certainly perk up sluggish EV sales. But there wasn't much detail about that. And also there was pretty light on detail about how Tesla plans to advance its so-called full self-driving technology to a point where actually it won't need any driver supervision. So we heard some analysts after the event sort of call this more of a controlled demonstration rather than a presentation.
Okay, Bloomberg's Katrina Nicholas taking us to the future. We thank you for that update on the latest Robotaxi. But speaking of difficult needles to thread, make or break moments, France has unveiled its budget for the next year, hitting big firms and the wealthy as it looks to trim its colossal debt pile. The country aiming to deliver 60.6 billion euros worth of tax hikes and spending cuts. Let's bring in Bloomberg's Caroline Gonan, who joins me now from Paris. Caroline, finally, we've got the details. Where's the axe going to fall?
It's actually a pretty big effort, actually more than we expected. 60.6 billion euros are needed in this budget. About two-thirds, in fact, a little bit more than two-thirds will come from spending cuts. And the ministries, the state, will actually have the biggest effort. They will not replace some public servants. Some public services will be merged. There will be less spending for the unemployment agency, for social security. The indexation of pensions on inflation will be delayed by at least 6 months, so less money for pensioners. Local authorities will also have to tighten their belts as much as 5 billion euros. In terms of what's going to come in, as you can see here, the biggest chunk will actually come from this exceptional tax on the biggest companies. We had a few more details on this. It's going to concern 450 companies with more than 1 billion euros of revenues. The tax will actually be even bigger for those companies generating more than 3 billion euros. We also found out about some exceptional tax on maritime transport, and even for smaller companies, some production tax cuts which were supposed to happen will actually be cancelled, and there will be less incentives for companies, for startups, for example, to hire young talents or lower income jobs, something that actually the business lobby MEDEF has said could damage employment. Individuals also will have to contribute to this budget. The wealthiest, of course, 65,000 of the richest households in France, those without children, for example, a couple earning more than €500,000 a year, those will be more taxed. The tax shields on electricity will all be gone because, you know, electricity prices have gone down. So they think they can put back some taxes on electricity, and transport finally will also be taxed. New tax on plane tickets expected, and new tax also when you buy a new car which is not an electric car. Not a very good signal, of course, just 3 days before the Paris car show.
Okay, so fears of an exodus of wealth from France, same fears as you've got in the UK at the moment ahead of the October 30th budget. But Caroline, of course, the point here was to try to balance the books. I wonder how much it's going to squeeze the French economy and whether this really is enough to comfort investors. What can we expect the response to be?
Well, we'll see the response very quickly today on the markets, of course, and also tonight with Fitch, the credit rating agency. They're going to publish their assessment tonight. They already downgraded France last year, and the French economy will need 300 billion euros of bonds in order to finance itself next year. So we'll see, of course, in the bond sales as well, the reaction from investors. There might be a few adjustments. Michel Barnier acknowledged it last night. He said he only had a few weeks to prepare that budget. The far left, which is quite influential in Parliament, as you know, has actually said that this budget will be completely changed. So, of course, the debates in Parliament over the next couple of months will probably be heated, and Michel Barnier may actually have to use this constitutional Article 49.3 in order to force the budget in Parliament without a vote. That's what was used, for example, last year in order to pass the very controversial pension reform without a vote. But that is, of course, assuming that Marine Le Pen, the head of the National Rally, doesn't support a vote of no confidence until then. She has already criticized this budget, especially the delay of the indexation of pensions, saying this would be a theft for pensioners. And we also heard finally from Pierre Moscovici, the head of the French state auditor Cour des Comptes, who actually said that there is too much taxes in this new budget, and he warned about the social discontent and French people being fed up with taxes.
OK, Bloomberg's Caroline Conan, we thank you for that reporting out of Paris. And we're going to continue this conversation at 8:30 a.m. UK time. We'll be speaking exclusively with the French Minister Delegate for European Affairs on this new budget. Interesting to think about how it fits into Mario Draghi's outlook and recommendations for competitiveness in Europe, the slow agony that he's warned of. But coming up on this programme, changes at the top. The automaker Stellantis replacing its CFO and kicking off a search for its top executive. We'll bring you all those details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. 6:18 here in London. Futures pointing higher for Euro Stoxx 50 futures. And let's get to a bit of a corporate shake-up now. Stellantis replacing its finance chief as part of a broad management overhaul as it really tries to regain investor trust and stabilise its business. The CFO, Natalie Knight, will be replaced by Doug Osterman. And we get more analysis now from Bloomberg's Oliver Crook, who joins us now from Berlin. So, Ollie, you've got Stellantis replacing its CFO. What's the backstory? What's the aim here?
Yeah, listen, Lizzie, after they got that profit warning about 2 weeks ago that sent shares careening after what has already been a very bad year for the auto sector and for Stellantis, there was already a lot of bad news priced in. They came out with that dramatic profit warning. Shares went plummeting. They had to do something. And that something, as we discovered after 2 days of board meetings over in the United States from the CEO, Carlos Tavares, is a reshuffle across the business. So it's a replacement of the CFO, the COO, the North American COO, the brand heads of Maserati and Alfa Romeo. And again, the backdrop here is a very difficult sort of landscape for the auto industry in general. There are some idiosyncratic issues over at Stellantis in terms of the large volumes of inventories they have over the United States. They've had issues with the unions. We've talked a lot about that, Lizzie. But Lizzie, if that was not enough, Tavares goes straight from that board meeting to Italian Parliament, where he needs to testify there because they're very concerned about factories closings and jobs getting cut. And right now at Stellantis, they're looking for the replacement of the CEO because Tavares himself, his contract is up at the beginning of 2026. The question is, for his last year, can he both weather this storm and bring exciting new cars to the market? And that's exactly what we're going to ask him when we speak to him on Monday from the Paris Auto Show.
OK, and difficult landscape, as you say, for the auto industry, as illustrated by those delivery numbers from Mercedes and BMW that we got for the China market. Not looking good, Ollie.
Yeah, that's right, Lizzie. Listen, we got profit warnings from those two car makers as well, and we got the delivery numbers yesterday, so we got a little bit more flavor as to what exactly was driving that. So overall, deliveries at BMW were down 13%. At Mercedes, they were down 3%. But as you say, Lizzie, when you drill down into that Chinese market, you think that that market has turned the corner? Absolutely not for these car makers. You could see it right there. Mercedes sales in China down 13%. For BMW, Lizzie, down 30%. So that is a 30% decline in BMW's biggest market. That is over in China. That is absolutely huge. Though I will bring you a little bit of silver lining, at least for BMW, because that's the China story. There's also a battery electric vehicle story that we're telling overnight from those delivery numbers. BMW has once again been able to outperform the rest of the market. They managed to get 10% growth in EVs. Mercedes, different story, down 30%. So a little distinction in there, Lizzie, but really overall a fairly poor picture for the auto market, generally speaking.
Yeah, you've got to wonder whether there's any hope of winning back that market share from these Chinese brands. Bloomberg's Oliver Crook, we thank you. He's already teased us. We've got this live reporting from the Paris Motor Show on Monday. We're going to be speaking to the CEO of Stellantis and a host of other leading figures from Europe's auto industry. So do join us for that. But staying with the EV story, the Republican presidential nominee Donald Trump says he wants to boost the US auto industry by making interest on car loans fully tax deductible and renegotiating a trade deal with Mexico and Canada. He was speaking in a key swing state, Michigan, the home, of course, to the US car sector. Trump also says he'd ban Chinese self-driving vehicles from American roads.
the autonomous vehicles. We're going to stop from operating on American roads. Remember this, I will close the loopholes under Biden and Harris that are beginning to allow Chinese vehicles to creep into American streets.
Well, coming up, governments pledge billions to capture and store carbon. We're going to be taking a look at whether it's enough to really make a difference. Stay with us for that. This is Bloomberg. President Joe Biden says Congress should return from its recess and pass emergency relief funds after Hurricane Milton caused widespread damage in Florida. The storm left at least 10 people dead and more than 3 million homes and businesses without power. Florida's governor says the state appeared to have escaped, though, the worst-case scenario. To the UK now, which has been at the forefront of Europe's carbon capture push. Last week, the government pledged nearly £22 billion to fund projects that capture greenhouse gases. But is the country on track to meet its targets? Joining me now for analysis is Tom Abraham, who is head of Bloomberg NEF's Sustainable Materials team. Good morning to you. So 22 billion isn't a small amount. We hear of this number all the time when it comes to the hole in the public finances. What impact do you think it's going to have on the UK's carbon capture industry and emissions?
Good morning. Yes, it is a significant amount of money and goes a long way in showing the support that the UK government is offering the industry. However, what we know at this point is that the projects that will receive this funding will together contribute about 3 million tons of annual carbon dioxide capture capacity and about 8 million tons of transport and storage capacity for the carbon dioxide. In comparison, the UK government has set a target of getting to about 20 to 30 million tons of carbon dioxide capture and storage capacity in the country by 2030. So there is a huge difference. The big challenge here is, that these projects take a lot of time and it's expensive. So things need to move on really quickly if we have to close this gap. And as things stand right now, it looks like a tall order to meet these targets.
And just very briefly, how does this compare to the rest of Europe stepping up funding for carbon capture projects as well?
The EU actually has a much more ambitious target of getting to about 50 million tons of annual carbon dioxide capture and storage capacity in the bloc by 2030. But the funding is not as big as what we've seen in the UK. So at BNEF, we estimate that about $16 billion has been allocated to carbon capture projects in Europe outside of the UK compared to about $30 billion that's allocated in the UK. So more higher targets, less capacity in terms of funding. So that means there's a huge difference there.
OK, Tom Abraham, head of Bloomberg NEF Sustainable Materials team. We thank you for that analysis. We'll have plenty more on the programme. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Chinese shares slide. Investors say cautious ahead of a government announcement tomorrow that could unlock up to 2 trillion yuan of new stimulus for China's economy. Tesla's long-awaited Robotaxi is here. Elon Musk unveils the prototype at a glitzy event in California, saying production may start in 2026. Plus, spending cuts and tax hikes on business and the wealthy. The French budget's €60 billion effort to tackle the government's colossal debt pile. Well, a very good morning. Happy Friday. We've got futures flat on both sides of the pond as we head towards the end of the week. We did, of course, have that US inflation data coming in hotter than expected yesterday, but also a slowdown in the labour market. And it's that second data print that actually seems to matter more at the moment to the markets. It's a difficult combination as the Fed plots its path ahead. Is it going to go from a jumbo cut to a smaller cut or even no cut at all? It kind of took the wind out of the S&P's sails yesterday after this record-breaking run. Wall Street futures, as you can see there now, flat to the downside. But if we flip the board and go cross-asset, you can see Treasury yields now pretty steady, having fallen on the paring back of those Fed cut bets. You saw a rise in the dollar, euro-dollar now 109, Brent trading at $79 a barrel, and gold at 2644 per ounce as we head towards the end of the week. But let's dive into that eco data out of the US. Underlying inflation rising more than forecast last month, and it represents a pause in this recent progress towards moderating price pressures. Core CPI, which of course excludes food and energy costs, increased by 0.3% for a second month. And we can speak now to Sinha Haldea, who is Global Head of Private Capital Advisory over at Raymond James. Good morning. Thanks for
having me
with me round the table. I wonder how you interpret this economic data and where it leaves the Fed and therefore equities, because I wonder, is it actually good news that the Fed maybe doesn't have to cut as aggressively as we thought?
Well, I think the question is now that the Fed is focused on this dual mandate. It was all about inflation for the last 2 years, as it should be. Now that they're also focused on the condition of the labor market, where do they go from here? Because it's all in the balance in terms of what the labor market data says and what the inflation data said.
Are they too focused on the labor market?
I don't think they're too focused on the labor market because they haven't been focused on it yet. However, the U.S. economy is doing well. Nothing's wrong. So what are they trying to fix? Now, rates are restrictive. They need to bring them into balance, so the so-called recalibration, as the Fed calls it. But what is that neutral rate? Everybody seems to have their own opinion. Somewhere around 3.5% in that range seems to be where consensus lies. So there is some easing to do, but at what pace? It's all about pace of cuts and the messaging behind it to the market. And I think that's where there's going to be some confusion. Last thing I'll add is there's going to be some noisiness in the data, given 2 hurricanes, given the strike last week. There's going to be noise in the data coming through for the Fed.
I'm thinking as well about the election and what lies further out than that in terms of the Fed. I mean, lots of people talking about the inflationary effect potentially of Trump. Do you think that actually we could see hikes from the Fed in 2025?
I think that, remember, the Fed is often criticized for being too backward-looking data dependent. So by the time you see the inflationary impacts and the Fed is willing to take action from it, we might be at the end of next year or beyond into 26. So right now, the path for rate cuts into the 3.5% range into 2025, that seems like the glide path. Now, of course, depends on how much Trump does and how quickly to impact the Fed's direction. But it will be backward-looking, and it's often with a 2-quarter lag.
And just while we're talking about Donald Trump, I think you've said that he would be positive for M&A, right? But when you think about J.D. Vance signing on to legislation that eliminates tax breaks for mega mergers, do you really think that this combination would be better for M&A?
I think it depends on whether that's actually policy that the Trump administration then implements or not. A lot is said, but what is actually done? In the last Trump administration, we do know, because we experienced a big deregulatory movement, especially when it comes to FTC and merger approval. That slowed down meaningfully under this regime, under Biden and Lina Khan. If Trump wins, that will certainly loosen up the wheels when it comes to getting M&A executed, and that will be good for the M&A banking business models around the world.
And if I can bring you to the UK, of course, Raymond James is one of the world's leading private wealth advisors. Are your clients packing their bags? Are they at the door as we look ahead to that October 30th budget?
There's a lot of noise around that budget and a lot of uneasiness, what to expect. And not a day goes by without us hearing about another constituent that may be impacted. So I think the messaging around this budget, needs some revisitation next time around. But yes, investors are worried because if you make the UK less competitive in a meaningful way, capital is mobile. Capital will leave. Now, we have seen indications last week that the carry taxation rules in this budget for private equity may not be as onerous as first indicated by Rachel Reeves. Same with non-dom. That's all good news when it comes to keeping the large pockets of wealth and their decision makers here in the country.
But I also wonder whether you could see the same out of France. Of course, we had their budget yesterday.
Indeed, but you have seen a lot of capital flight when it comes to big pools of private equity capital out of France. France has a private equity community, but it's a relatively small one compared to that of the UK. Same thing with UK public equities, right? The regulation and the lack of competitiveness now means that the UK's public markets are smaller than Canada's. That's not a good signal for our markets here, and they require support. So I think that's what we're looking for, is how much does that anti-competitiveness movement actually impact UK versus other cities.
It's interesting that you also say that private wealth is increasingly interested in private equity. Why do you think that is?
Because of diversification, right? You have a very interesting time in the markets where certainly for the last year and a half, fixed income was a great place to be parked. Now you may want to dial into equities, but equity valuations, well, we've said a lot about that on this show and others, still remain punchy. Private equity means diversification to wealth portfolios around the world, and means that you are still able to enter certain sectors, certain geographies at good, sensible pricings, anywhere between 8 to 15 times EBITDA, depending on the sector. And that's a good entry point compared to publics.
And so what are you focused on this earnings season?
Well, looking for earnings normalization and looking for where guidance comes out in 2025, right? Because of where inflation is, it's come down quite a lot. You can't pass through margin expansion to the customer. So where is that earnings growth going to come from? Those drivers are going to be particularly interesting.
Okay, really interesting. Sunaina, Haldea from Raymond James, always good to have you around the table. We thank you very much. And I mentioned earnings. It's kicking off today. We've got US bank earnings getting underway. JPMorgan's top line seen as robust on higher trading revenue and IB fees. But over at Wells Fargo, fee growth in deposit-related and investment management businesses probably won't be enough to offset shrinking net interest income. This is what the analysts are saying. But let's get some analysis, a bit of a preview from Bloomberg's Charlie Wells. Charlie, good morning. We've seen bank stocks rebounding since tumbling off that JPMorgan warning last month. Do you think there's enough concern about net interest income baked in?
Well, all eyes are going to be on that metric today. Net interest income is the largest source of revenue for these big banks. And Daniel Pinto of JPMorgan last month had to warn that maybe analysts' expectations were too positive. And in a high rate environment, that metric had come in so strong. It had come in at record levels last year for banks. And so management, particularly Pinto at JPMorgan, really wanted to kind of set kind of lower expectations there. The question here, though, is this just sort of, a management tactic to kind of set lower expectations and then exceed them? Later today, we'll figure this out. But this is a real concern for these banks because it is such a huge source of revenue for them.
OK, and then is this the season that finally we'll get to see some robust deal making?
We have been hearing about this for years, and bankers love to say that we are just a few seconds away from this kind of deal pipeline starting to flow and flow and flow.
Often around this table.
I remember last year sitting here talking about the Instacart IPO and how there was going to be this huge wave of IPOs that would come. It really seemed to look more like a bit of a ripple. But if you look at some of the expectations for, say, JPMorgan, their equity underwriting has been particularly strong. So if they are able to bring in those fees, not just from this quarter, but also going ahead, that could offset some of the hit they take on net interest income.
And Charlie, where you've seen bank stocks up significantly this year, what are investors going to need to see that positive trajectory and keep it going?
Great momentum for the banking sector so far. So JPMorgan, that share price up 25% year to date. That's beating the S&P 500, which is, up about 21%. Even Wells Fargo reporting later today up 17%. And look, this is really going to hinge on whether or not they can successfully pivot to this lower rate environment. If they can, take the hit from net interest income where they're maybe making less on loans, but maybe they get more loans coming in the door. Maybe they get more fees from investment banking. Maybe the consumer is stronger, so some of that credit risk goes down. That's going to help keep these stocks going forward. What could make them go backward, what could make them decline, is if we see a gap here, is if we see a hit in net interest income, but not a speedy pivot to that lower interest rate environment. We don't see that pickup in activity, that's what could be negative for these banks.
OK, Bloomberg's Charlie Wells, we thank you, setting us up for those bank earnings that are coming out later today. But we've got plenty else on the docket for you as well. In about just under 20 minutes' time, we'll get the latest UK GDP numbers. Crucial, of course, for Keir Starmer, the new UK Prime Minister, who's heading towards his first 100 days in office this weekend. The expectation is for a decent, if slower, pace of growth in the third quarter, so we'll keep an eye on that. And then at 1:30 p.m. London time, we're going to get the US PPI reading. Could this give us a bit of comfort to balance out that CPI print yesterday? And then around noontime in London, we'll get JPMorgan, Wells Fargo as well, kicking off those bank earnings. So plenty on the docket. But coming up right here on Bloomberg Daybreak Europe, we're going to explore how AI is coming to the legal world. We'll be speaking to Eleanor Lightbody, who's CEO of Luminance, a company here in the UK bringing artificial intelligence to that sector. That interview next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, AMD suffered its biggest stock decline in more than a month after it unveiled new AI chips at an event in San Francisco. Investors had also been hoping for new information on customers and financial performance. The stock remains up 11% this year. AMD has emerged as the biggest contender to Nvidia in the lucrative market for AI processors. Well, the AMD CEO and President Lisa Su tried to reassure investors, saying that she's optimistic about demand for the industry.
This is an incredibly fast growing market. I mean, if you think about, what we've done just over the last 12 months or so, we've seen MI300 demand increase from when we started the year to, in our most recent earnings, we actually said we would be over $4.5 billion in this important AI accelerator market.
So Lisa Su there, and there isn't a sector that AI isn't touching, and that includes the law. On the one hand, artificial intelligence is a legal minefield, so it'll create a whole load of new work. But on the other hand, there are also fears that it'll do a lot of the work that lawyers once did themselves. Or looked at another way, it'll spare them a lot of drudgery. Luminance is one of the companies offering that service. It's developed a legal large language model, and I'm pleased now to be joined by the CEO, Eleanor Lightbody. Great to have you with me in the studio, Eleanor. What I usually hear from tech CEOs is that AI isn't going to kill jobs, it's just going to let humans get on with more creative and analytical tasks. So for all the petrified paralegals out there, what can't Luminance do that a lawyer could? What are its limitations?
Absolutely. So at the moment, what Luminance is really helpful with is, as you said, those repetitive tasks that are high voluminous in nature that, quite frankly, paralegals don't have enough time to get through. So think about like NDAs and how many they're reviewing on a daily basis. And so it's really there to augment their work. What AI can't do is think for them at the moment. So it's there to really accelerate and help them be more efficient. But there is still lots that they can keep busy with.
I mean, surely your tech is going to replace a lot of lower level jobs, because why would a company pay for humans and AI if they could pick AI and save money?
So if you think about it today, when I speak to GCs or lawyers, they're all faced with quite similar problems. So overflowing inboxes, regulations changing at rapid rates, too much repetitive tasks that they just don't quite have the time to get through, plus the fact that they have a lot of information standing in their contracts that they don't have time to really mine and look at. So I think, quite frankly, at the moment, it's all about driving efficiencies. It's all about augmenting their work on a daily basis. And everyone is really happy with that. OK, so how does the legal industry look in 5 years, 10 years from now? In 5 years' time, I think what you'll see is AI being at the centre of very high voluminous tasks, but low value tasks. So the likes of those NDA reviews. And I think you might start to see AI either side of that. And that will allow for lawyers to free up their time to think about things more creatively, to be value to add value to businesses on top of what they're doing today.
But of course, you're not the only company in this space. In Europe, it's kind of pretty fragmented, I think, compared to the US. You're prominent here in the UK. You've got the likes of Pocket Law in the Nordics. What's your strategy to dominate Europe? What do you offer that your competitors don't?
I think that, well, the first thing is that we built a proprietary large language model that has been trained and exposed to hundreds of millions of legal contracts. Now, that's really important in this space because trust and accuracy are absolutely key. So a lot of other people are using general models, which is great. They're great for, rewriting an email for you or writing a poem. But actually, they've been trained to give you an answer and an answer at all costs. When you're working with lawyers, you want to make sure that the AI knows when to hand it back to the human. You want it to tell you, you know what, I'm not sure about this answer. And that's exactly how we've trained our AI. And second to that, there's a lot of point solutions. So there's some really interesting technologies out there that are solving a piece of the problem. Whereas at Luminance, we're doing it end to end. Our AI really helps across the board for creation of contracts, negotiation of contracts, and then finding things within contracts.
But are you worried about competition from the US, from, for example, Ironclad?
So in the last 18 months alone, our corporate product has grown by 225% in the US. So we've got a lot of organic demand, and our customers include AMD or Koch Industries, and it's a really exciting time for us.
What about regulation? Is it a help or a hindrance here in the UK?
I think there's a lot to be seen yet. I think that what we want to see is when regulation comes, that it's agile enough and flexible enough. It's such a fast-moving environment that we need to make sure that we think about that. Yet to be seen.
But have you found the new administration easier to work with than the Sunak administration?
I haven't spent much time working with either administration. So.
I suppose that speaks for itself. What do you want then from Labour?
Yeah. I think it's really important to have a share of voices around the table. So at the moment, it's great that you've got big tech, and you've got academics, and you've got the government, but also some of the best AI companies are coming out of two-man teams out of Cambridge University or something like that. Making sure that they're included in the conversation around regulation, I think, is important.
Yeah, it's kind of amazing that this, as you say, started in Cambridge around a whiteboard when Gen AI wasn't even talked about. It wasn't cool. But as you say, it was founded by two men, and tech remains very male-dominated. I've been to lots of tech conferences this year, surrounded by men. As a female tech boss, do you think more needs to be done about this? What should be done about this?
I always think that more can be done, absolutely. But I think that we've seen a change in the last 5 years. And so I think it's up to myself and other females in tech to really just celebrate what we're doing, explain what we're doing, and encourage people to come and mentor them, and hopefully that will increase.
All right. Eleanor Lightbody, CEO of Luminance, great to have you with me around the table this morning, looking at those developments in the legal tech industry. Really exciting company there. Now, as we say, in the UK, it's a really crucial moment for Keir Starmer. We've got this investment summit coming up on Monday. He's just announced his new investment minister, who actually was Eleanor's old boss, Poppy Gustafsson. But at this 100 days moment, it seems the Prime Minister is already reaching for the reset button. He's told this tale of doom and gloom over the summer, ministers emphasising the £22 billion hole in the public finances, but kind of failing to acknowledge that the economic picture has brightened. You've got inflation back near the BOE's target. You've got growth, as you can see, actually picking up here in the UK. We'll get the latest numbers at 7 a.m. But as we digest the past 100 days of government, there's this fear of tax hikes on October 30th. It actually seems that the international landscape perhaps has been easier for him to navigate. And you've got the polls showing, one from Opinion, that half of voters don't approve of his performance. So we look ahead to that investment summit and the budget on October the 30th. Plenty more to come up on Bloomberg Daybreak Europe. Do stay with us. This is Bloomberg. So it's been a busy week when it comes to the Fed's rate path ahead and digesting the Fed minutes, the CPI print yesterday. We look ahead to PPI today. But actually, what seems to have affected traders the most has been the US jobless claims surge. And we had this against the hotter than expected inflation print yesterday. Actually, a slowdown in the labour market. You can see jobless claims, the biggest jump in 3 years. And if we flip the board, over 12K of that rise was actually in the areas where Hurricane Helene hit, so Florida and North Carolina. And if you take a look at the latest Fed pricing, flip the board again, you can see traders have been pulling back on their Fed rate cut bets. Traders went from pricing in about 170 basis points of cuts next year to now 110 basis points of cuts, which really leaves all eyes on that PCE number on October the 30th as we look ahead to the Fed meeting. But this really is quite a turnaround. If you think we had that jumbo cut from the Fed, now the debate turns to whether we'll have a smaller cut or no cut at all at the next meeting. 2 quarter-point cuts, if we look here, is actually seeming to be the new status quo. So all of these fabulous charts you can find on the terminal. Just go to GTV Go and they'll take you to all of these. But do stay with us on Bloomberg TV. We've got plenty more on all your top stories of the day. Coming up on the opening trade, we're going to be speaking exclusively to the French Minister Delegate for European Affairs. That's all about the new budget there at 8:30 a.m. UK time, that conversation. And then on Monday, we'll be going live to the Paris Motor Show, where we'll be speaking to the CEO of Stellantis and a host of other leading figures from the European auto industry. The opening trade's coming up next. Anna Critty and Guy will be taking you to the market open. Stay with us. This is Bloomberg.